Good morning, everyone. My name is Linda Cutler, and I am the Director of Marketing here at Empire Valuation Consultants. And we'd like to welcome you to the Employee Stock Ownership Plan ESOPs 101 webinar entitled What, Why, and How. And this is a joint presentation by Empire Valuation Consultants, ESOP Plus, Schatz Brown, Glassman, Casal LLP, and Capital Trustees LLC. A few housekeeping items to note. All participants will be in listen-only mode. If you have any questions, there is a toolbar to the right with an area to type in questions. So please feel free to do so, and we will address those questions if they are pertinent during the presentation, or we will collect them and make sure to answer all of those questions at the end. Please note that this presentation is also being recorded, and we will make sure to give you a link that you can either refresh yourselves on the topics afterwards, or you can feel free to forward it to some folks who weren't able to make it. And lastly, we will have it on our website and our colleagues' websites to access later on. Also note that on the right side near the question area, there's also handouts for the presentation, and we will also send those out subsequent to the call. And now I'd like to turn it over to Brett.
Good morning, everyone. Thanks for joining us. I'm going to introduce our presenters this morning. Rob Hilton is a manager at Empire Valuation Consultants. He holds a BA from Emory University and an MBA from the University of Rochester. Rob has over 20 years of experience and has provided hundreds of valuations for employee stock ownership plans, gift and estate planning, buy-sell agreements, and more. Rob is a member of the ESOP Association and has spoken on valuation issues, as well as served as a panelist at association conferences. Mark Casal is a partner at ESOP Plus, Schatz Brown, Glassman, Casal LLP, and specializes in employee stock ownership plans, including implementing ESOP transactions and compliance with IRS and Department of Labor requirements. Mark is a graduate of the University of Michigan and Albany Law School, and he holds an LLM in taxation from the New York University Law School. Mark's strong background in taxation helps clients maximize tax advantages in their ESOP transactions. Mark is an active member of the ESOP Association and the National Center for Employee Ownership, and frequently speaks on topics relating to ESOPs, ERISA, and tax matters. As for me, my name again is Brett Kiesling. I'm a managing director of Capital Trustees LLC. I'm a graduate of Elizabethtown College in Pennsylvania and the Widener University School of Law. I've been involved in the ESOP community since 2008 while serving as outside counsel to a company that became a 100% ESOP. I eventually became president of the employee-owned company. I'm active in the ESOP community and a strong proponent of the benefits of employee ownership, including the positive effects on the bottom line. I'm a member of the ESOP Association and the National Center for Employee Ownership, and I also speak frequently on ESOP fiduciary issues. And now we'll turn it over to Mark Casal.
Great. Let us start off with talking about what an ESOP is. An ESOP is an employee stock ownership plan. An ESOP can be thought of as being a part retirement plan and part corporate finance tool. Now, as a retirement plan, an ESOP is similar to a 401k or a profit-sharing plan in that it's treated as a qualified defined contribution plan and has to follow the rules under the tax code and ERISA. Now, ESOPs, contributions to an ESOP is going to generate a tax deduction for the company. In addition, ESOPs enjoy tax-deferred growth for employees. The employees will not recognize income until they receive a distribution after they retire or terminate service, which can be many years down the road. Now, unlike a 401k plan, an ESOP is designed to invest primarily in employer stock, company stock. In addition, an ESOP is permitted to borrow money. An ESOP can borrow money from the company in order to purchase stock from a selling shareholder. Now, an ESOP, just like any other qualified retirement plan, has to have a trustee. and a trustee exercises control with respect to the management and disposition of the assets held by the ESOP. Now let's turn our attention to the corporate finance tool aspects of an ESOP. There are tax advantage financing for the company. As I said before, contributions to an ESOP are going to generate a tax deduction for the company. And because the ESOP is getting this tax deduction, it can effectively pay back outside bank financing with pre-tax dollars. In addition, the company can pay dividends or deductible dividends to the ESOP in certain circumstances. In addition, S corporation ESOPs are generally income tax exempt. Now, the income of an S corporation is going to be passed through to the shareholder, and in this instance, the shareholder will be the ESOP. So there will be no shareholder level tax because the ESOP itself is a tax exempt entity. Now, Brett is going to talk a little bit about the brief history of ESOPs.
As you'll see on your slide on page 7, the ESOPs were created as part of ERISA, the Employee Retirement Income Security Act of 1974. There are currently approximately 10,000 ESOPs in the United States with about 10.3 million employees. According to figures, about 10% of the private sector workforce work for employee-owned companies. 5,000 employee-owned companies are majority-owned by the ESOP, and approximately 4,000 are 100% owned. About 330 ESOPs, or 3%, are publicly traded companies, and about 70% of ESOP companies are or were at some point leveraged. The other thing that we would point out is that in terms of what industries or sectors are ESOPs, they really run the gamut from manufacturing, distribution, retail, book manufacturing, engineering firms, really just about any type of business you can think of probably is represented in the ESOP community. Rob?
I mean, I think there's some concentrations that you do see within ESOPs. I mean, I believe manufacturing companies oftentimes see it. Engineering firms are regular occurrence. Construction firms oftentimes, and more recently breweries. Microbreweries have added a lot of ESOPs as well. So there are a lot of different industries with a lot of different business models where it's been an effective value-enhancing tool.
Rob, that's an excellent point. One of the interesting things, for example, the breweries that we see that are ESOPs, there are some companies that are in an industry or in a geographical location that just really seem to fit in the cultures of employee-owned companies. And a lot of the microbreweries happen to be that. They've got a cool product, it's new and trendy, and employee ownership is a way to share the wealth, the benefits with their employees, so you're absolutely correct. Rob, do you want to take us to the next slide?
Sure. Now, you're probably asking yourselves, okay, well, how do ESOPs generally get put into place? And as we indicated on the last slide, majority of ESOPs are created vis-a-vis leverage. And we've got here a diagram or a schematic that kind of lays out the way that the cash flows of an ESOP transaction generally work. I'm following along here with the pointer, and hopefully that's showing up in your screen. In this case, we've modeled out how a bank is going to be providing the financing, and we will go through later in the discussion some different ways that an ESOP can be financed. But for this purpose, we're going to talk about how the bank is going to be provider of the financing. And in this situation, the bank is going to lend that money over to the host company. And in exchange for that loan proceeds, the bank will take back a note and will generally be collateralized by the assets of the company. The company then is going to send those proceeds over to the ESOP. And the ESOP, when it starts implemented, it becomes a new legal entity. And so there will be a loan that goes between the company and the ESOP. The ESOP then, in turn, now has the funds and will go send those funds over to the selling shareholders. In exchange, they will receive the stock. Now, in this situation, the collateral that's going on between the company and the ESOP is actually going to be the stock that was just acquired vis-a-vis these proceeds. And so you've got what's known as a pledge agreement that, again, occurs between the company and the ESOP. And as the loan between the company and the ESOP is paid down, then those shares get allocated to the individual participant accounts. So again, this is a general framework for how ESOPs are often structured or often created. And with that, Brett, can you tell us a little bit about what's happening here when you do create an ESOP?
Well, when an ESOP is created, it's because the selling shareholder is selling all or part of their shares, and selling shareholder or oftentimes shareholders are looking to sell their shares. It's often combined with a management buyout, and it can spread the sale of shares over many years. It offers diversification for the seller. Oftentimes, their assets are all tied up in the shares of their company, and it allows them to diversify. They can retain many of the control elements for the seller and the management. In other words, they sell their shares, but the selling shareholder absolutely has a place in the company. And you can defer income tax potentially forever. Linda, do I understand? Do we have a question?
Yes, we do. This actually relates to the previous slide, so pardon me for going backwards. The question is, what is meant by financing loan proceed? I think that might be for Rob.
Yep. No, the financing loan proceeds would be usually be the negotiated value of the ESOP stock. So we'll talk a little bit later about how an ESOP value is created and that value relative to other potential means of company stock sale. But in this instance, what we're talking about is that the bank is providing the source of funds that go through ultimately to the selling shareholder.
All right, and we're going to go to Mark Hassel now for slide number 11, page 11.
All right, let's talk about tax benefits to the selling shareholder. There's a code section called 1042 that allows the selling shareholder to defer capital gains tax. And the deferral capital gains tax in some instances could be forever. Now, in order for 1042 tax deferral treatment to apply, certain criteria have to be satisfied. First of all, this 1042 treatment is only available to C corporations. S corps cannot participate in a 1042 sale. Next, the ESOP has to purchase qualified employer securities. What this means is that the ESOP has to buy stock that presents the best dividend and voting rights. In addition, the selling shareholder has to sell at least 30%, or rather the ESOP has to own at least 30% of the stock of the company. This could be accomplished in tranches. So the selling shareholder could sell 10% of the outstanding shares to the ESOP in year one, and then in year two sell another 20%. That second sale, that 20%, would qualify for 1042 treatment because the ESOP at that point in time has 30% ownership. The selling shareholder has to have held the stock for at least 3 years in order to obtain 1042 tax deferral treatment. One of the negatives in 1042 treatment is that the selling shareholder is not permitted to participate in the ESOP, cannot be a participant in the ESOP. In addition, certain relatives of the selling shareholder are not allowed to participate in the ESOP as well. Finally, the selling shareholder has to purchase qualified replacement property within 3 months before the sale to the ESOP or 12 months after the sale. Now, qualified replacement property, also known as QRP, is nothing more than stocks or bonds issued by a domestic operating corporation. And if we look at the next slide, this will illustrate the tax saving comparison between a taxable sale to a private party and a sale to the ESOP. Now, under both scenarios, the sale price is $30 million. Let's assume that the selling shareholder's basis in his stock is $5 million, leaving $25 million of appreciation. In the taxable sale to the private party, there will be $6.25 million of tax. In a 1042 sale, there is no tax. And as you can see, the net proceeds in an ESOP sale is $30 million because 1042 there is no capital gains tax. And in a taxable sale to a private party, the net proceeds is only $23,750,000. And that just illustrates the effectiveness of a 1042 treatment. So, Brett, why don't you take the next slide?
I will, Mark. And just to be clear on what you just finished up, the net proceeds, we're saying that's the net to the seller.
Exactly.
Excellent. On slide page 14, we'll talk briefly about the tax benefits and savings for S corporations. If the corporation makes an S election, there will be no federal tax on its annual income. And a lot of states, many states, mirror this provision. So that is very critical. With no federal tax, oftentimes that's how the company finances payments, growth, et cetera, et cetera.
I mean, one of the things that does come up when you do have S corporations that have a lot of ESOP stock is this tax benefit creates an enormous advantage over competitors. I mean, it's the fact that you're not paying income tax in most cases with a high degree of an S corp, especially 100% S corporation. It really is a very strong competitive
Rob, that's
advantage.
a great point. For example, the S corporation is able to build up excess cash because it's not paying dollars, tax dollars out, and it could fund future expansion projects or make acquisitions or do whatever. But it has a competitive advantage by building up this extra cash.
When I was president of an employee-owned company, one of the great fun aspects of my job was we would look at that tax savings as a way to pay back the company for the loan to finance the ESOP. But we would do the long-range planning and say, boy, once these loans are paid off, what are we going to do for growth, expansion, or that sort of thing? So it can be a very exciting part, and your point is well taken. Absolutely a competitive, significant competitive advantage over your competitors that don't have that. Although income will be passed through to the shareholder, which is the ESOP, no shareholder level tax will be imposed because the ESOP is a tax-exempt entity. And then the income tax liability will be effectively deferred until the participants in the ESOP receive their benefits. What that means is every year, and we'll talk about it a little bit more, participants are allocated their portion of the ESOP shares into their account, but they don't accrue any tax benefits until they leave the company and end up getting paid for it. Yep. All right, and with that, we'll go on back to Mark Kostoff.
Okay, so let's compare that scenario where the ESOP owns 100% of an S corporation to the situation where the ESOP owns less than 100% of an S corp. Their tax exclusion here is going to be in proportion to the ESOP ownership, which could potentially lead to it having a cash flow neutral treatment when you compare it to a C corporation. And let's walk through an example just to illustrate this concept. Let's assume that the ESOP owns 30% of an S corporation. The annual taxable income is $1 million. The individual non-ESOP shareholder income allocation, 70% or $700,000. Now, in order to cover the tax liability to this individual shareholder, the company is going to distribute $245,000. The company also, in order to avoid the second class of stock rule, has to distribute $105,000 to the ESOP, meaning the company has just made $350,000 of distributions in total. And if we look at the next slide, there's a chart that shows C corporation versus ESOP S corporation cash flow or net to equity consequences. And this is based off of the example I just listed. The earnings of the corporation is $1 million, both C and S. If you're a C corporation, you're paying income tax at 35% or $350,000, leaving net income to the C corporation of $650,000, which means net to equity is $650,000. Now, if you compare this to a partially owned ESOP S corporation, where the income is also $1 million, the dividend that the S Corp has to pay to the individual and ESOP shareholder is $350,000. As you can see, the net to equity is also going to be $650,000, having a neutral impact or a neutral effect on cash flow if it's an S Corp versus a C Corporation. And all this means, if the S Corporation has a need to build up extra cash to fund future expansion activities, it's far better off for the S Corporation to be owned 100% by the ESOP than to be partially owned by the ESOP. So, Rob, can you take the next slide?
Sure, I'd be happy to. Now, we've talked a little bit about some of the differences between C Corps and S Corporations, but one of the things that kind of is coming into play for both of them is that the contributions that are made to the trust by the company are deductible. So the net effect of this is that the debt that the company takes on is effectively made with pre-tax dollars, or is paid back with pre-tax dollars. In almost every other financing situation that I can think of, the interest expense is deductible, but the principal is not. And so here again is another benefit of ESOPs that comes into play, where you can generally effectuate, in effect, both the principal and the interest becomes tax deductible. Another thing, kind of switching subject or switching gears a little bit, that happens with a lot of companies that are ESOPs is that you find that ESOP companies become more profitable and have superior sales. There are some fairly robust studies that have been performed that compare companies in the same industry that are generally the same size. And again, they have shown that the ESOP companies have superior sales, superior growth, and improved productivity. And again, I think it gets back to kind of the shared capitalism, the skin in the game that employee ownership brings about. And so again, everyone benefits a lot of times, very frequently. Brett?
Rob, I just want to share an anecdote that I often share with my clients, and that's when I was president of an employee-owned company. It was a manufacturing distributorship. We had one of our initial ESOP meetings, and one of our service technicians, really talented blue-collar guy, raises his hand during the meeting, and he says that he thinks that the company should eliminate Christmas bonuses and put the money back into the company to grow the ESOP. Now, it wasn't a great idea per se, because first off, you know, if spouses are expecting Christmas bonuses every year and suddenly we eliminate it, you're going to cause friction at home, and we didn't really want to perceive that we were taking benefits away. So his idea wasn't necessarily a great one, but what really impressed me and has really framed my thinking for the last 7 or 8 years is that if you have a guy who's willing to give away his holiday bonus in order to grow the company, you are clearly looking at a class of employee that is thinking differently than someone who's just earning a paycheck working for the man. You know, to me, it was just a sign that there's really something to this ESOP culture that if you can benefit it, the company is going to grow by leaps and bounds. I understand, Linda, do you have a question?
Yes, we actually received a question from David Grunberg, and we received others as well that we will most definitely address at the end. But this question is related to conversion of a potential C Corporation to an S Corp. Is it possible to start off as a C Corp for the years paying off the ESOP loan and then convert to an S Corp for the added tax benefits?
Yes. And actually, we find that this is not uncommon, where a company that's a pre-existing C Corporation, the seller takes advantage of the 1042 tax deferral, which Mark talked about a little while ago, and then once that's occurred, then the company changes over to an S Corporation, particularly if the ESOP holds a significant percentage of the stock, so therefore they gain a lot of the tax benefits, the income tax benefits. There are some wrinkles that are related to the size of the payroll and the amount that's deductible, and a few other little wrinkles which are beyond an ESOP 101 discussion, but this does happen, I would say, not uncommonly.
Yeah, and the only thing I would add is when you're converting to S status, that's usually done the subsequent taxable year.
And one thing that I do want to point out is that it's absolutely critical. ESOPs, like most areas of specialization, aren't something for people to dabble in. There are severe tax consequences or legal consequences if things are done wrongly or improperly. So you really want to make sure that the experts that you use, either legal or valuation experts or fiduciaries, are really up to speed and specialize in ESOPs, because the ramifications can be quite serious if you're not. I understand, Linda, you have a couple of more questions? Oh, we're going to wait at the end. I
Actually,
apologize.
Brad, do you want to carry on with transitioning the benefits to the participants?
Yeah, and the benefit of the participants, look, at the end of the day, ESOPs are simply a qualified retirement plan. That's what they are. The benefits the beneficiaries, the participants, and we call them participants, although generally we're talking about the employees, don't receive any cash value until they separate from the company. So it is a retirement benefit. The allocation of ESOP assets in cash and or stock is normally in proportion to their salary to covered payroll, and the criterion that are used to allocate to the participants is generally based on salary and length of service are the two factors that go in. Tax deferred, the payments, as we discussed earlier, are tax deferred until the payment is received. And payout, by the way, it's not unusual for it to be done over a period of up to 5 years after separation from the company. And finally, as we've talked about, the employee owner has the power to affect their own wealth in retirement. Rob used the words that employees tend to have skin in their own skin in the game. I told the anecdote of the person willing to give up his bonus. In ESOP companies that really foster a good culture, the benefits to the company and to the participants really know no limits. Rob?
Sure. So you're all probably asking, well, how much can I get for selling my stock? And how does this all get financed? And the regulations outstanding say that the ESOP cannot pay more than adequate consideration. And the regulations go on to identify adequate consideration to be effectively equal to fair market value based on an independent appraisal. Now, the question then comes up, okay, well, that's nice, but how does that compare to alternative sources or sale prices that I might be able to get for my company? When we bring in an ESOP, we're frequently looking at the company as it is today with its existing management and cost structure in place. And so we generally will ascribe a value based on that set of cost structure that is there. And so the value may be lower than the seller might conceivably be able to receive if they were to, say, sell the company to their competitor across the street or to a group that may be doing a national roll-up within the industry, where those organizations or those groups very well could be looking to cut out a significant amount of expense, particularly at the management level and the back office level. And so they have higher prospective cash flows from acquiring the company in that situation, and they oftentimes are willing to pay more than the seller might be able to receive with an ESOP. So,
but Rob, that premium associated with a synergistic purchase could be offset in part by a 1042 election, deferring the capital gains.
Yeah, it can. Yes.
Yeah.
That is true. That if you do sell that company to the competitor across the street, then you are going to be paying capital gains on that.
Exactly.
You're right, Mark. That instead of goes to an ESOP, you would be able to defer the gain with an ESOP sale.
Rob, one other thing, if I can just jump in, and the trustee is actually the one who buys the shares. at the end of the day, and we're saving much of that details for another webinar. But when my partner and I are negotiating for the purchase as trustees, it's different than if we were using our own money and buying it for ourselves. If we were the purchasers as individuals, we would want to strike the best possible deal, which means paying as little as we could for it, is the reality. In an ESOP transaction as trustees, our obligation, our legal obligation, is to have a fair deal, not the best possible deal. So there could be some additional value that the selling shareholder receives because, again, I don't have a legal obligation to get the best possible deal to negotiate every last penny down. It could be that you can get a little more value than if it were a truly a hands-off, disinterested transaction.
Yeah, and that's a good point, Brett. And there's other elements that do come into play with an ESOP transaction that usually are not the case with other transactions. Is that the owners oftentimes can retain in management position, and a lot of times are still on the board of directors, and so therefore they are still in a control position with many elements of control.
And often, Rob, if I can just interject, frankly, the agreements are such that if it's leveraged and the owner doesn't receive all of their proceeds right off the bat and it's paid out over time, oftentimes the agreements reflect that the owner, the selling shareholder, will maintain a place on the board for as long as they are owed any money. So there are protections built in for the selling shareholders.
Yes. Oftentimes, again, continuing on, the owners can keep their job and being in a position of management, and along with their salary and perks. Some of that gets into the negotiation of when the ESOP is formed, and that such that there's cash available for the stock or for the selling shareholders. That again is just part of the negotiation. The more that comes to the ESOP, the higher the value for selling the shares. But again, that's kind of the give and take that occurs there. As Brett was saying, a lot of times that the owner can continue to participate in the future value of the business. And again, as we've talked about, the ESOP, once in place with a good culture, a lot of times ends up leading to a faster growth and better productivity, and that seller, again, depending on how things are structured, can oftentimes participate in that future growth. So.
You're right. Rob, we have a question from Linda.
Yes, we do. Can an ESOP sale be structured in a way, for example, the owners could sell the company but not with the land or property?
Well, the answer is yes. However, if the land or the property is housed in the corporate structure, you would have to do some type of reorganization to get the property outside to be held by a different entity. And then you would effectively sell the remaining or the resulting corporation without the property in it.
What happens is that a lease gets written between the company and the whoever or whatever holds the land, and generally would need to be at a market rate, because if it were above a market rate, then arguably the company should move to a third-party location where they'd be paying a market rate. So the common thing that occurs in that type of situation is that a lease is written between the company and the landlord, whoever happens to own it. So we've talked about some of the pricing that can be received and some of the elements that go into an ESOP transaction. So the question then becomes, and we've talked about a little bit earlier, is where's the money come from to make this happen? And we talked about earlier, the bank is a primary source of funds, and banks generally look at a couple of different characteristics of the subject company. One is using assets as collateral. It could sometimes be real estate. Sometimes it's heavy-duty fixed equipment. Sometimes it's receivables, inventory. They're, in essence, general collateralizing assets. And typically, a bank will offer its most effective rates when they do have assets to collateralize against. Another type of bank financing, which happens frequently, I would say, with service firms like engineering and architectural firms and the like, is you'll have banks lending against the cash flow generating capacity of the company. The banks tend to have a little bit higher rate in those types of situations, simply because they don't have the degree of asset collateralizing, but it can, again, be a very competitive rate that will be received. A very common way that ESOP transactions get formed is that the seller themselves takes back a note in exchange for their shares. In this type of a situation, the seller will negotiate as part of the transaction the rate that will be taken on the note, and they get paid out over time for their shares. And there are some tax reasons that this might be advantageous. We're not going to get into it here, but there are some reasons why the seller may wish to do that. Further, as kind of a general benefit, the seller is likely to be a lot more willing to work with the company if there were problems down the road, certainly more willing than the bank might. So that again, is a nice thing to have when you have a seller financing. Linda, we have a question?
Yes. Rob, what is the maximum term of an ESOP leverage loan?
What is the what?
What is the maximum term of an ESOP leverage loan?
You want me to answer that?
If you want to, sure.
Sure. Generally speaking, I've seen ESOP loans go out 25, 30 years, but it's not entirely uncommon for them to go out further than 30 years.
Now you're talking about the loan between the company and the trust.
That's exactly right.
Which would be different than the loan between the bank and the company.
That's correct.
Yeah.
Yes.
So the loan between
the company and the ESOP itself, which the driver for that is the longer the loan, the longer it takes for the participants to get shares allocated to their account balances. And the thought is, if you make it too long, then you're really giving a benefit to the participants. So you're really acting in the best interest of the participants. But if you sell, for example, all of your stock to an ESOP, you really want to have a loan that's sufficiently long enough, such as 25, maybe even 30 years, where you're going to not only reward current participants with shares of stock, but future participants that come along down the road, new hires, they will still be able to get benefits from the ESOP.
And all of this is determined when the transaction is being designed, correct?
That's correct.
You know, so before someone gets too long down the path, all of these things are identified and quantified even before someone is locked into proceeding.
Right, yeah, these are all negotiated points pursuant to the transaction, yes.
So getting back to the ways that ESOPs are financed, again, the two most common are bank financing and seller financing. Occasionally you'll find situations where the bank is not willing to lend the entirety of the funds needed for the whole transaction. In that case, mezzanine lenders are occasionally brought into play. They necessarily would be subordinated to the bank debt and would necessarily charge a higher rate of interest. So that is an avenue that's there.
And Rob, isn't it very common to combine seller financing and bank financing?
That happens as well, where you have the seller becomes the subordinated note holder,
right.
You know, coming in behind the bank. So that happens too. A couple of other ways that plans are financed. Occasionally, an ESOP will be created. Cash will be sent to it, and then subsequent to that, the transaction will occur where they use that cash that's already in place to buy the stock. And there are a couple of nuances where other retirement plan assets can be brought to bear to help pay for the transaction. A couple things to keep in mind, though, when we do compare an ESOP loan versus some other loans, we are talking generally about a pretty highly leveraged transaction. And here, difference-wise, for an ESOP transaction versus, say, a general bank loan, the funds when you've got an ESOP transaction are going to go to the selling shareholders, and so they necessarily are leaving the company. In contrast, when you have a more traditional bank loan, say, those funds are going to be used for things like acquiring or making an acquisition, adding, growing the facilities, maybe buying some real estate, basically things that prospectively would increase the value of the company going forward. So that is something to keep in mind, but again, it is good to have the debt service be, generally speaking, tax advantaged, which again helps offset the fact that the cash flow is going to be leaving the company versus helping the company grow.
Right. Rob, I think Linda has another question.
Yes, a clarification actually. If an ESOP loan were being paid off over a 5 or 10-year period, Rob, did you say that new hires after the loan is paid don't participate as ESOP owners?
No, that's not what was said. People are participating. I believe that maybe the confusion was Mark had indicated that if the loan goes too long, that it may not be considered a benefit to participants. But the loan length doesn't have anything to do with whether a participant is a participant. Basically, if you work for a company during the period of time where the ESOP is in place, as long as you put in enough hours over the course of the year, and certainly full-time employees more than satisfy this, then they're going to be participants in the ESOP. So the loan funding does not have anything to do with who participates or who doesn't.
So Mark, are there some things that frequently come up?
Sure. Let's talk about some common ESOP fables. The first one is employees will run the company. This is just not true. Employees of an ESOP company don't have a say in day-to-day operations of the company. Employee participants are nothing more than beneficial owners of the company. They are not the legal owners.
Mark, one of the things that my partner and I say when we have participant meetings is if you didn't have the authority yesterday, you don't have new authority today. You can't fire your coworkers. You can't paint the company van in a color that you like. If you didn't have access to the company checkbook yesterday, you don't get access to the company checkbook today.
That's exactly right.
It is not a socialistic approach where suddenly management decisions are made by committee. Does not happen. You still have the hierarchy. You still have people doing their jobs. You still have people reporting to their bosses. Sometimes being told, shut up, you have to just do your job. So it doesn't change anything like that just because they're an employee.
That's exactly right. And the only thing that a ESOP participant will have a say in is significant corporate actions that require shareholder approval, significant shareholder approval actions such as mergers, sales substantially all the assets of the company, consolidation, liquidation. Those type of actions, participants get to direct their vote to the trustee. So they get to tell the trustee how they want to vote their allocated shares. Another fable, employees will have access to financial and confidential information. As Brett indicated, this is clearly not the case. This is not true. However, some companies have an open door policy where they will give the employee participants financial or confidential information and share the numbers with these employees. That's a board of director decision. That's not a ESOP participant decision. They can't force confidential information from being disclosed.
And Mark, open book management is certainly a topic that's discussed in the ESOP community at our conferences and annual events. And the culture can lend itself to open book management in some cases, but it's not required, it's not mandatory,
right.
It's not part of that.
Exactly. There's no inherent right to receive financial or confidential information. Another misnomer is that the seller cannot receive fair market value for the sale of his or her stock. This is absolutely false. The seller is entitled to receive up to fair market value, can't get a premium, as Rob mentioned before. You can't sell to you can't get a synergistic premium when you sell to an ESOP, but you certainly can get fair market value. Another fable has to do with the seller must guarantee the ESOP loan considerations. This is generally not true. The selling shareholder 3 or 4 years ago might have been asked to pledge their QRP to guarantee the bank loan or to personally guarantee the bank loan, but in today's environment, banks are more often than not willing to lend the company money without having the selling shareholder guarantee the loan. And finally, because the business owner controls the transaction, timing is not important. This is not true again. You know, there are estate planning considerations that could certainly make timing very important in entering into an ESOP transaction. So Rob and Brett are going to talk about the next slide.
And this is our final slide, and then we'll move to questions. So demographics, the baby boomers are approaching the age where it's time to look at an exit strategy, as Rob said much earlier in our presentation, and that's why the needed exit strategy has made this a particularly good time for ESOPs.
Yeah, and this page right here really highlights a number of elements that all are kind of confluencing today that suggest that this is a very good time to put in an ESOP. You know, as Brett indicated, we've got a lot of baby boomers who are needing an exit strategy for the companies that they perhaps started. Valuations today, stock prices are at or near record highs. The interest rates on loans similarly are at very close to near record lows. And finally, as Mark just indicated a moment ago, the banks today versus say 3 or 4 years ago are lending a lot more loosely than they were. I mean, some of the restrictions and the covenants that they were asking for has certainly gotten a lot better, and the dollar amounts that they're willing to lend have gotten a lot better.
And a quick note on banks, Rob, it's not unusual for your ESOP advisors to recommend banks who might be able to do financing. The fact is there are banks who just don't get it, don't understand ESOPs, aren't trying to understand ESOPs. So it's not unusual if a company goes to their traditional banker and the banker just says, no, we don't understand it, we're not interested. But there's money available. It may not be available from your current bank, but there are certainly bank dollars available for ESOPs without question. And then finally on the taxes, capital gains and other taxes are generally, this will not be a surprise, considered more likely to go up, to increase than to go down. And certainly you want to put a transaction in place before tax rates rise. And with that, that concludes the primary part of our presentation. Linda, I understand we have a handful of questions.
Yes, and this is great. I mean, it's just merely a clarification of the great points that you had made earlier in the presentation. So there's a couple here. The first one I want to start with is a question came from Michael Wall. Thank you, Michael. Is this a disqualified person? And I had asked, are you referring to the selling shareholder? And he said both or either. The issue is whether the remaining 50% shareholder is a disqualified person due to continued participation in the ESOP.
So I think the answer as to whether the seller is able to participate in the ESOP or not depends on the how it's structured and some of the nuances associated. Mark?
Yeah, if you're doing a 1042 election, like I said before, the selling shareholder is not allowed to participate in an ESOP. Relatives of the selling shareholder are also not allowed to participate. In addition, a 25% or greater shareholder is not allowed to participate in the ESOP as well? And I think that is the question. Yeah.
Okay, another question, Linda?
Yes, this is a question from Tiberio Schwartz. Thank you, Tiberio. I'm going to try to ask this question as clearly as possible. Selling shareholder wants to sell 100%. I assume the corporation will not be able to borrow full purchase price. Can the corporation make a large down payment and then owe the balance to the selling shareholder? In the real world, will banks allow payments of the balance to shareholders before the bank has been paid in full?
As the answer very broadly is yes. First of all, it is not unusual. We talked about seller notes earlier, where the company, if they have cash on hand, can pay part of the price, the sales price, out of current cash and give the seller a note for the balance. So that is routine, and that's very much part of it.
Yeah, and similarly, a lot of times the banks will be willing to lend up to a certain dollar amount, and then if the total transaction is above that dollar amount, again, the seller can take back a subordinated note, and oftentimes it could be structured where it's interest only until the bank debt is paid off, and then the seller receives payment. So it's part of the negotiation and part of how it's all structured.
Absolutely.
Terrific. The next question comes from David Watkins. Thank you, David. We keep mentioning S corporations, but what about LLCs?
LLCs cannot sponsor an ESOP. You cannot. The ESOP has to purchase qualified employer securities, which is stock in a corporation. If you have an LLC and you want to sell out to an ESOP, what you have to do first is to convert to corporate status. And once you're formed as a corporation, then the selling shareholder at that point in time can sell to an ESOP.
Linda, the next question.
Okay, thank you. Another question that we received, let's see here. Sorry about that. Is there a general rule regarding valuations in terms of the number of years, multiple of earnings that represent value of the company?
That's kind of a valuation question, and without spending a lot of time talking about how we would get into valuing a prospective company, we would certainly take into consideration the pricing multiples that are in place of companies that are publicly traded, which are generally similar or in the same types of industries, as part of our analysis in trying to assess the value of the stock for the company putting in the ESOP.
And Rob, very broadly, and I know Linda will touch upon this briefly at the very end, but we're planning upcoming seminars, webinars, one of which will be devoted to valuation issues, one of which will be devoted to trustee fiduciary issues, and one to the legal issues. So some of the valuation specific questions are likely to come up in a future webinar that we're doing. Linda, another question?
Terrific, yes. Here is a question from David Hermiton. Thank you, Dave. If a company fails during the term of the loan, what are the repayment responsibilities of the ESOP members?
None. The ESOP participants are not owners in that sense. There's no obligation to kick in any contributions towards a bankruptcy. The bad news is that the participants are likely to be an unsecured creditor and not get any proceeds. So if a company goes bankrupt, there's no special protections to the participant. But if the question was, do the participants have to kick in towards paying off the debts of the company? Absolutely not.
Absolutely not. But keep in mind that the ESOP participants' benefit, if you will, is tied directly into the value of the company. So if the company is bankrupt, then the value of the company is going to go down dramatically.
Absolutely.
Great. Thanks, guys. This is a question that actually came up ahead of time from Donald Benvey. Thank you, Donald. What are the requirements for professional services corporations when starting an ESOP in New York?
Yeah, professional service corporations, I think the laws do change a little bit in each state. Within New York, and ESOP, or actually all non-professional shareholders can be up to 25% of the overall stock. If it's desired to have an ESOP that's a larger percentage, what typically happens is that a management company is created, which will, the ESOP will own the stock of the management company, and then a management service agreement is created between the professional corporation and that management company. And there's a lot of details that have to get worked out.
Exactly. In essence, the management service agreement acts as a mechanism for shifting the value of the professional service entity over to the management company. And it's at the management company level where the selling shareholder sells to the ESOP. Okay.
Linda, we have a few more questions, and then we can
We're
wrap
running
up.
very short on time. But yeah.
Yes, we do, and we are getting towards the top of the hour, so we'll do our best to address these. The next question is from David Grunberg. Is there a legal requirement that the ESOP have a board of directors or a governing council?
It's good management, it's good governance. In terms of legal requirements, here's the problem that you get into. If you are the selling shareholder and you remain as a sole board of director member, and we call it wearing too many hats, you're setting yourself up for bad facts and for problems to arise down the road. Part of the approach that we have very frankly, and I don't know the facts that this question arises from, but there's often a mentality among founders and entrepreneurs who build their company who say they don't need any outside expertise or guidance. We look at a board of directors as being good management, that they advise the company, that they assist in growing the company. So we believe fundamentally that the board should not be looked at as something that the government's imposing on you, but rather as a good management tool that should be utilized for the company growth. Linda?
Great. And the last question that I see is, what is a fair rate of interest for a seller note?
And the answer to that is it's going to depend. It's going to depend upon what the current rates are in the marketplace, and it's also going to depend on the size and the relative risk of that note. It's going to factor in the subordination or superior nature of itself within the claim. So there are a lot of parameters that go into deciding what is an appropriate rate of interest for that note.
And Rob, isn't it often just one more factor in the totality of how the seller is being compensated?
Absolutely.
So it fits in that it's just part of the broader picture
of an overall transaction. That's right.
Exactly right.
That's right.
Great. That's all of the questions that we have. If there are any other questions that you have, certainly feel free to reach out to any of us. We'll be happy to address those. You see the Contact Us page in front of you, and it's also part of the slide deck that you can all access or you will receive after the fact. Another housekeeping item very quickly, just a disclaimer that the opinions expressed in this presentation and the presentation materials were not intended to be used as legal or valuation advice. So please consult with counsel as necessary. Also, as Brett had alluded to earlier, this is going to be part of a series. There is a survey that's going to pop up right after this presentation. We encourage you to please fill it out. That's just going to help us. If we're hitting the topics and we're answering your questions and what we could do in the future that would be beneficial to your business and exit planning strategies as a whole. So please be candid. Please let us know what you'd like to do. We're going to cover, as Brett had said, valuation, legal, and fiduciary issues, among other things. So thank you so much to Brett, to Rob, to Mark, to our IT manager, Britton Robbins, who did a phenomenal job, as well as our speakers. We really appreciate your time today. Thank you so much. And again, please feel free to reach out to us if you have any questions. And again, I'm Linda Cutler, and I'm the Director of Marketing here at Empire Valuation Consultants. Thank you so much, everybody. Have a great day.